Hello and welcome back to Dukascopy TV. Now, after a sharp climb to the top of the hill, the US stock markets are at record highs. But is this climb set to continue? Joining me to discuss is Bruno Estier. Bruno, thank you very much for coming in today.
Hello, Monica.
Now, could you firstly just talk us through some of the trends that we are seeing in the US stock market and whether or not there is going to be a historic plunge, as some are saying?
Well, we just had a correction which was about 10% in the Japanese market. The Japanese market has been moving up together with the US market, making new highs in the US market. And the question is now to step back and figure out what is really happening. Is it a new trend which will continue at the same speed and pace, or is there some risk that a pullback could be coming in the next 12 months? The first thing we need to look at is step back about 100 years. Usually technicians use a special vocabulary to define periods which are difficult. These periods which are difficult are when buy and hold is not possible anymore. There are three of them that, as we can see on the charts, called secular bear phase in the 20s, in the 60s when the S&P was below 120, and recently since 2000, where we have been in a kind of sideways trading range where we just recently broke above it, but that's the whole question. The thing that we like to notice and keep in mind from this chart is, number one, that in the mid of the 70s, namely in December 1974, we had a nominal low which was followed afterwards by a series of lows, but which were above that one. And we would like now to focus on 2009, the low that we had recently on the financial crisis, and see if the pullbacks that we might have will also remain above that low of 2009. For that, we introduce other things. Technical analysts look at two famous cycles, the 4-year cycle called the presidential cycle and the 10-year cycle, the Juglo cycle invented by an economist in the 30s, which is the so-called investment cycle. The interesting thing is to decide where to anchor this cycle of 10 years. Before we mention that, we would like also to notice this little hacked line on the top of the two cycles, which could be probably something called an asymmetric cycle. Asymmetric because it's not topping in the middle between the two lows. As we see, usually it moves up about 30 years and it has correction period intense in the 30s, less intense maybe in the 60s, though from the top to the bottom in 1974 we had also a decline of 50%. And certainly presently, where we moved from 2000 from the 1550 area down to 666, which was certainly a little bit more than 50%. So we are now under the influence since the beginning of 2012 of a rising 10-year cycle. And that could explain why the market is testing and has moved up above the previous highs. Now, what could happen with the other cycles? And then we can move to the next chart, where we basically have projected forwards the cycles. We see that we had something which was very regular. In the 80s, 1990s, everybody remembers some crazy war event, 94, 98, which was the FX crisis in Thailand, 2002, that 4-year cycle was very regular. And because it was regular, people were expecting in 2006 something. And they were deceived, or disappointed, sorry. Could have been deceived by the cycle as well. But what happened is that the rising market in 2006 extended 1.5 year or so more. That had not happened before, except in 1987. So a few technicians already in 2007 were quite leery and anxious that 1987 would not replicate. Well, it did not replicate the same way, but there was quite a correction, and we all know about that. We would like to draw the attention that now the period could come where we could have 12 months of correction. Why? Because we have already spent 4 years since March 2009, and we are already past March 2013. And also by chance, the 4-year cycle is showing up its low, theoretical low, in October 2014. So instead of predicting a crash, which is not very interesting, because probably too difficult to time, there is too few of them, we should be interested by a gradual decline from the price level that we are now, probably in the area of 1680, or maybe with a retest of this 1680 towards 1700 plus minus 10 or 20 points on the S&P, and then a failure to sustain these highs and start to move down. And this move down could last 12 months and doesn't take times. It could first move down in October of this year, then rebound, and everybody will say it was a small correction, maybe only 10 or 15%. But then the surprise will come in 2014 when it will extend to what, 20 or 25 or 30%. And that would be very nice for many technicians, because they would find again their lovely 4-year cycle, which would come again on time. We will see.
Now, one of the things that seems to be a question is whether this decline would be as sharp as in 2008. Do you foresee this being the case, or not quite as harsh, would you say?
It's probably not going to be so harsh, because people have been in bonds for a long time, and they will only gradually move out of their bond funds into equity. And every time now that we are going to have a 5 or 7 or 10, even 10% correction, people will move out of the bonds, going back into the equity. And that would probably create a very gradual decline. And only in mid 2014 will we realize that, in fact, from the top to the bottom, we have already lost 20 to 30%.
It does seem as though we're teetering at the edge of the roller coaster. How it will play out will be interesting to see. But Bruno, thank you so much for your insights today. It's been a pleasure chatting it through with you.
Thank you.
Well, that's all from Bruno and myself for today. Please do click back to Dukascopy Television for more press reviews and exclusive interviews. Goodbye for now.